Most traders lose money because of one simple reason. They treat every market the exact same way. They think because a setup worked last month, still should work this month. Same entries, same rules, same size. But when the market dries up, and you're still trading like it's booming, you're gonna bleed. They force trades when the watch list is weak. They size up when the volume is gone. They stick to plan A when they should have shifted to plan Z instead. It's not that their systems suck, because they try to trade every phase the same way. But once you know the cycle, you know when to wait, when to strike, and when to sit on your hands. So today I will be explaining the 4 market phases. Phase number 1, accumulation. The price is flat, nothing is trending. On the surface it looks dead, but underneath the big players are quietly building up their positions. This is a phase where most traders get bored, and boredom is dangerous. You're staring at your watch list and you think, I have to trade something. You overtrade setups out of FOMO. Your edge isn't failing here. You're just playing in the wrong environment. And most traders who lose money here is because they can't sit still. And this is why it happens. Institutions, they don't rush. They accumulate their positions over time, slowly, quietly, without spiking up the price. Big players, they load up on cheap supply. They want to buy without drawing attention. And this is why the price stays flat, even when volume is slightly increasing. Retail isn't in yet. It is prep, but still no party. And this is how traders get wrecked here. They force breakouts on a non-breakout phase. They chase every fake pop. They expect trending setups in a sideways market. They size up too early and get clipped, and start doubting their system because nothing seems to be working. So here is what you can do as a trader. Your number 1 goal here is survival. Sit, observe, stay light or flat, build a watch list, look for rising relative volume, track which tickers are respecting their levels, and wait for breakouts with commitment. This is your reckon phase. Be a sniper, not a scattergun. For day traders, this is where you must have discipline. Trade only A+ setups. Preferably clear range setups near key levels. No, maybe it goes straight, tight risk, small size. You are not here to be active, you're here to be accurate. You don't want to lose money because you just can't sit still. This is a phase for the traders who need action, they die. And the traders who need precision, they sharpen their edge. And if you can't sit still in accumulation, you're not a trader, you're a gambler with a trading app. Now we go to phase number 2. This is where the action happens. Price breaks out of accumulation, transform, everything just feels clean. Price constantly makes higher highs. Volume increases, especially on green days. Patterns work, entries feel obvious. Retail traders, they flood in the market feeling they finally figured it out. This is where the traders make most of their money, because it's the only phase designed to reward you. And this is why it happens. Institutions already built their portfolios in accumulation phase. Now they start pushing the market higher to draw in the retail money. Institutions, they push the price up with increasing volume, and retail traders, they pile up as they see momentum, and new retail money fuels the trend even higher. Here, the market wants you to feel safe, because the more people jump in, the more liquidity there is for the big players to sell into. This phase feels like pure euphoria, and that's why it's dangerous. You feel unstoppable, your scanner is full, your setups are working, and you keep on sizing because you feel invincible. But here's a trap. The longer you stay euphoric, the less you notice when the cycle is about to shift. And this is how traders get wrecked here. Ironically, this phase wrecks traders not because it's so hard, but because it's too easy. You start overtrading because everything feels green. You get sloppy with your entries. You start sizing in too much because you think that a market owns you profit. You keep on holding positions as momentum starts to fade when the phase ends. Traders, they get rich here, but they lose it all when the music stops and they don't notice. So what to do in this phase? Your job in the mark up phase is to press your advantage. without losing your discipline. Be aggressive but precise. Only trade your A+ setups. Size up on clear, trending setups. This is where you make your money. Take profits along the way. Don't let greed erase your wins. Track volume. Rising volume is a healthy trend. Volume are warning signs. It's okay to be aggressive in this phase. Just don't forget that it's just a phase. For day traders, this is your bread and butter. But it's also where you can get overconfident. Trend following setups work best. Breakouts, pullbacks, momentum scalps. Avoid hesitation. Fast entries, fast exits. Ride momentum. Don't marry your setups. If it stops working, bail out. And be aware of FOMO. It's easy to overtrade when everything is working. Don't chase garbage. Trade fast. Lock in profits. And when things stop working, don't hesitate. Step on the brakes. Markup phase feels like the market is finally respecting your skills as a trader. But it's not your skill, it's just the right environment. And if you can make money here, good. Just don't assume that it will last forever. Because when this phase ends, traps begin. Phase number 3, that is the distribution phase. And the distribution phase is a phase where the market tricks you in thinking that it's still bullish, but it's already dying. Price moves sideways, slightly upwards, but without commitment. Fake breakouts above the highs, failed support bounces that look like dip buys. Volume is inconsistent, spikes of activity, but nothing sustained. It feels like the market is just taking a break, but in actuality, it's setting traps. This is why it happens on a macro structure. Institutions, they're unloading their positions, but they're doing it slowly without alerting the retail crowd. They're selling into strength, selling to their supply of buyers, chasing the last phase of momentum. Institutions, they don't panic sell. They offload quietly to avoid crashing their own positions. Volume may be high, it's more about rotation than continuation. Retail traders, they think the market is just consolidating before the next leg up, but in actuality it's dying. This phase is designed to manipulate your emotions. Retail traders, they feel FOMO from the markup phase. They keep on trying to buy every dip or every breakout. They think it is just consolidation, it will break up again, and then their patience is weaponized against them. The market wants you to believe that it is still bullish because your buy orders provide liquidity for the institutions to exit. This phase destroys traders because they do not realize they're trading inside a trap. They're forcing breakouts, thinking the next one will run, but it fails. They buy every dip, thinking it is just a pullback, but support keeps on breaking. They overstay their winners. They see profits evaporate because they just assume that it will continue, and they ignore the volume cues. By the time they realize the trend is over, they have already given back their gains. So what to do here? Your job in the distribution phase is to be defensive. It's not the time to be aggressive. Take profits faster. It's no longer a clean trending environment. Reduce your size. If you're trading here at all, it's better to stay small and precise. Avoid breakouts. They are more likely to fail. And watch for breakdowns. Failed support, they are warning signs. If you're not sure if you're in the mark-up or the distribution phase, it's distribution. Play defensive. And for the day traders, avoid high-risk entries. Breakouts are statistically weaker. Trade ranges instead. If you insist on trading, trade near extremes. Short near resistance, long near support. Stop trading size. This is where scalps or small calculated plays make more sense. Watch for sudden reversals, and the market will look bullish one moment and fall the next. Your A+ setups are now B- setups at best. Recognize that and adjust. The distribution is the market cruel joke. It looks like it's going to explode higher, but only stalling so the big players can exit. If you don't see the difference between the mark-up phase and the distribution phase, you will give back everything you made. And when this phase ends, it is not gentle, it's brutal. Then we go to the markdown phase. It is where the market crashes. Everything you think should hold breaks. Price consistently makes lower highs, and lower lows. Support levels that worked before get obliterated. Failed breakouts lead to hard reversals. Panic selling, capitulation, desperation. This feels like everything is rigged against you if you're trying to go long. This is why it happens on a micro structure. The institutions, they're already out, but the retail traders, they're left holding the bag. And when they panic, it triggers a chain reaction. Institutions, they sold their position during the distribution phase. Retail traders, they keep on buying the dips, convincing the trend will turn. And when panic hits, it hits hard. Stops get triggered, margin calls wipe out accounts. The market is in free fall. And all that is left is fear. This phase messes with your head if you refuse to accept that a cycle has changed. Retail traders, they think it's just another dip bounce. They can't believe that their favorite stocks are dropping so hard. They double down on losers instead of cutting them short. Panic leads to revenge trading, trying to make it all back. People get desperate here, abandon the discipline, and they start gambling. This is how traders get wrecked here. Most traders lose everything because they refuse to accept that the cycle has flipped. They chase dips, keep buying cheap stocks because they're getting cheaper, and they're refusing to short. They think it's too risky to short, to bet against the market. Overtrading, trying to force long setups in a bearish environment, and emotional trade, trading out of panic, fear, desperation. They keep looking for mark up setups in a markdown environment. Your job in the markdown phase is survival or exploitation. Go flat if you're uncomfortable with shorting, then stay out. Trade short if you know what you're doing, because in the markdown, that is where the shorts make their year. Cut losses fast, don't assume the bottom is in. And you can look for capitulation. Huge volume spikes combined with panic selling signals potential bottoms, but don't be a hero. This phase can kill your account or can be the most profitable phase of your career if you know how to short. For day traders, this phase is either heaven or hell, depending on how you play it. Shorts, they thrive. Breakdown setups, failed bounces, panic-driven momentum. Avoid long setups. Until you see a true capitulation reversal, stay away. If you must play long, be surgical. Take profits fast. The markets are not forgiving here. Don't be forgiving for your own mistakes. The markdown phase is the phase where traders quit the game. They don't recognize that the rules of the market have changed, and by the time they do, it's too late. And if you don't know how to profit from panic, your job is to survive it. All right, now you know the 4 market phases: accumulation, markup, distribution, and markdown. But the real question is, how do you actually know in which phase you are in? Because if you can't spot it, you're playing the right game but with the wrong rules. This is how you can recognize each phase. So in the phase number 1, the accumulation phase, is how you spot it. The SPY and the Qs, they're range bound, they're choppy, low volatility. The volume is low and flat, and that is especially true for the S&P and the Qs. Your scanners feel dead or full of junk, and there are just a few clean setups. The overall chart patterns you will see are mostly sideways consolidation, failed breakouts, not a real trend. The easiest way to recognize this is you feel bored. You are forcing trades and you start questioning your strategy. If you're overtrading out of frustration, you're probably in accumulation. Phase number 2, mark up the momentum phase. This is how you spot it. The SPYs and the Qs, they're trending upwards, making higher highs, higher lows. The volume is rising consistently, especially on green days. Your scanner is full of clean setups, multiple stocks are running. The chart patterns you will see are breakouts, pullbacks, trend continuation. Here you feel confident, euphoric, and unstoppable. Here's a tip: if everything feels easy and clean, you are in the markup phase, so attack aggressively. Then the phase 3, distribution phase. This is how you spot it. The SPY and the Qs, they're moving sideways, there's not a clear trend. The volume there spikes randomly, but overall it's declining. The scanners are still active. You see breakouts failing more often. So the chart patterns, to recognize it, you have more choppy ranges and less follow through. And here you can feel more confused, more frustrated, chasing breakouts that don't work. So here's a tip. If setups that worked last weeks are failing now, you're in distribution. And then we go to phase number 4, the markdown phase. This is how you spot it. The spike consistently makes lower lows, lower highs. The volume have huge spikes, panic-driven sell-offs. The scanners are dead or weak. And the chart patterns you will see here is more breakdown patterns, failed support holds, and panic selling. If everything you buy keeps dropping, you are in the markdown phase. Stop trying to catch the knife. And then we go back to phase number 1 and we have the whole story again. So right now, you know each market phase, you know how to spot them, you know how to trade them. But it is worthless if your indicators suck. So watch this video. Because if your indicators are giving you garbage signals, you're screwed, no matter how well you read the phases. Watch this next, how to actually use indicators. You're welcome.